So 50% devaluation in your currency. Some would say that this obviously could spell a lot of doom and gloom going forward, but it seems that it has been taken quite well, and of course now could actually benefit the people on the ground. Counter argument is that we could actually see more inflation feeding through into the country. What is your argument?
I think that we were expecting, around 40 to 50% devaluation. Don't forget, there was a two-tier market trading. So in the offshore market, was really trading at these sort of 240s, 260 levels. Inflationary pressures, I don't believe so. I mean, the late president had a firm view that a weaker currency was inflationary only. If the importers are buying currency at 260, you're importing inflation anyway.
Yeah.
What's happening is your exporters are getting no benefit from a weaker currency because they're trading at the official rates of 166. So all in all, I mean, inflationary pressures, I don't think so at all. Sure, there'll be bits of it creeping in. I think very good for the economy. I think it's exactly what we were expecting for the currency.
And now sitting at 249.50, it was sitting at 165.
So yeah, I mean, that's the deval. I mean, the deval took it up to 250. So we're comfortable there. I think it's a good level.
Okay, so one of the reasons that this also is occurring is to unblock the frozen aid into the country. Do you think that this is going to filter through? It is quite an important point, given the fact that the foreign exchange reserves in the country have now only 1 month cover.
Yeah.
They say it should be 3 months cover, so there's a bit of concern there.
Part of the problems was that they wouldn't allow the currency to weaken, so that caused a bit of a stumbling block with the IMF. The IMF is the indicator for the donor funds. If the donor funds are making up 40% of your required import cover, you'd have to have the donors there. You can't turn them away.
Absolutely.
So I think with the IMF saying they wanted a weaker currency, there was strong pushback. The IMF was still in negotiations. This is good for the IMF. I think you'll see money coming in from the IMF side of it to assist them. But I think more importantly, the donor flows, I think we can see a bit of an uptick now. Whereas donors would run around the whole world trying to find the best rates for their dollars. So they're going to sit there trying to get the 240s and the 250s for the dollars they're taking in. But then they're being forced to go officially into the country at 167. And 164.
So the last going, coming through there.
So I think now they'll get the rates, and they're happy now to trade again at these rates, and they can trade, directly to country.
Okay, what do you make of most countries? I mean, a lot of African countries actually peg their currency to the US dollar. Do you think that this is, the wrong thing to do?
I don't necessarily think it's wrong, as long as you allow the peg to creep. So if you sit with a fixed peg and you become adamant it's going to go no further, then that's the problem. But if you've got a reasonable band on it, if you've got a reasonable creep in line with inflation, your inflation versus the rest of the world, then it's okay. But free floating is obviously the preferred method.
Okay, so tell us about what's going to happen on the ground. You're saying that no real inflation could actually be imported because of the import-export scenario that was playing out previously. Is there any specific environment that could actually play out differently for the people on the ground? Obviously, now that the currency has been devalued 50%.
Look, it's a tough one to accept, but I mean, that your currency is suddenly so much weaker. But had it been allowed to creep over the last 3 years, we've been close to this rate anyway. So I think on the ground, it's probably going to push up. They could say it push up the price of imported goods. But if the exporter is shipping the goods at an inflated price to compensate for the fact they're paying more, it all pans out.
Does it change the price of bread and milk and essentials? What actually is the effect of a devaluation of 50% for people on the ground?
For imported goods, and they're going to be buying it at the rate they were buying it at anyway.
Yeah. So in other words, if I was a shopper now, I wouldn't be changing the price of my goods essentially.
Well, you shouldn't.
Well, this is.
But I think that some of them might try and take advantage of it.
Yeah.
But yes, I expect there will be mild inflationary pressures, but not hectically, not a 50% jump. Inflation's not going to go to 30% there. It might tick up into the 10% band, but I don't think it's a concern. I think it's good for them in that what they're going to get back from it now, from the donor funds. More importantly, you're going to see the flow of the dollars from the tobacco auction, which is very pleasing for us to hear that the central bank is saying these flows are now going to go back to market. Previously they allowed it to come into market, and as soon as they got their funding, they stopped it again, and they took it back into the central bank coffers. These flows are going to go to the market. It's going to feed the pipeline. There's a massive pipeline of demand. We've got a lot of clients there trying to get money out of there that have done business there and can't get money out of it. So the result is they do less business.
Yeah.
So now with them able to get paid, they're going to be able to do more business there and feel more comfortable. It'll take a while. It's going to take a little while for this whole thing to actually build up, to actually get this pipeline reduced. But the last time we had dollars flowing in from the tobacco auction, we actually saw a big reduction in the pipeline of demand. And I think that's the positive from it. From where we're sitting, we think it's all very positive for Malawi.
Fantastic, Roy. Thank you so much for joining us. Great to have you in studio. Roy Daniels, Head of Africa Trading at Rand Merchant Bank.